Welcome to the Introduction to Double Entry Bookkeeping Concepts module. This is the first module for our Bookkeeping Basics course. This is also a standalone course for small business owners and others who just want to brush up on the Introduction to Double Entry Bookkeeping concepts. My name is Kathy Grosskirth, and I will be your facilitator for this module and for the Bookkeeping Basics course. This lesson introduces you to the concepts of double entry bookkeeping. For those of you taking the entire course, before you dive into the hands-on components, you need to understand some key concepts and learn definition of key terms. For those of you who are just getting a refresher, you still need to understand these key terms to understand how the double entry bookkeeping process works. Now here are the topics we'll be covering in this lesson. Accounting versus bookkeeping, the accounting cycle, types of business entities, separate entity assumption, internal controls, double entry bookkeeping defined, chart of accounts, the accounting equation, and financial statements. Our first concept is explaining what accounting is versus what bookkeeping is. Then we describe how they relate to each other and how they are intertwined. Finally, we will see how important the bookkeeping process is to a sound accounting system. Accounting is basically the documenting, analyzing, and reporting of financial data in a systematic and timely manner. Bookkeeping is a function of the accounting system. It is basically the receiving, evaluating, and recording of financial data in a systematic and timely manner. For the accounting system to work properly, the bookkeeping function needs to work properly. In other words, if your bookkeeping procedures are not solid, then your accounting system will not be solid and will not function at its best. Therefore, it is important to understand that solid bookkeeping is the foundation of a successful accounting system. The accounting function is only as good as its underlying bookkeeping function. The accounting cycle refers to the particular accounting-related tasks which take place during a one-year time period. The company's accounting cycle corresponds with its fiscal year, which may or may not correspond with a calendar year. For the purposes of this course, we will work on the assumption that our accounting cycle corresponds with a calendar year which runs from January 1st, 20XX through December 31st, 20XX. For those of you taking the entire course, it is important to understand that we will not follow all these steps as presented. Rather, to teach the concepts of double entry bookkeeping, we will work with T accounts, which are similar in principle to the individual ledger accounts. As we work with the general journal exercises, we will then share how the T accounts relate to our ledger accounts. Once you understand the underlying concepts of record keeping, it should all make sense. Now we will list the tasks in a typical accounting cycle. First is receiving and evaluating transactions. Second is journalizing or recording transactions in the journal, which includes the general journal and or any specific journals for cash accounts, receivable, and etc. The third is posting journal entries in the individual ledger accounts, which I said resemble the T accounts. The fourth step is preparing the trial balance. The fifth step is recording adjusting entries and preparing the adjusted trial balance. Number 6 is preparing the financial statements. Number 7 is recording the closing entries and preparing the closing trial balance. And the 8th and final step is preparing the closing financial statements. There are 3 basic types of business entities. Each have their advantages and drawbacks. We will discuss each in detail, starting with the sole proprietorship, which is a business set up by a single person, either as oneself or doing business as or DBA under a trade name. The easiest business type to set up but leaves the individual the most vulnerable for any debts of the business, i.e., creditors can come after the individual's assets for any debts or liabilities from the business. In addition, depending on how much revenue a sole proprietor earns, the individual may be double taxed on his earnings, both as an individual and as a business owner. The second type of business entity is the partnership. This is a business where two or more individuals create a business as equal or unequal partners by contractual agreement. It's a bit more complicated to set up. It also leaves the individuals vulnerable for any debts of the business, but the liabilities are somewhat limited based on their ownership percentage in the business as well as the stipulations of the contract. In addition, as with a sole proprietorship, the partners may also be subject to double taxation on their earnings, both as individuals and as business owners. The third and final type of business entity we will discuss is the corporation, which is a business venture set up as a separate legal entity which is treated as a legal person that is legally separate from the individuals who own the company. The main advantages are certain tax advantages for the owners, but the major advantage is that any liabilities for the business remain that of the corporation, and under most circumstances, creditors and others cannot come after the owners separately for a corporation's debts or liabilities. Suffixes on a business or an individual's name such as Inc., LLC, or PC indicate that the business or individual, if in certain professions, are set up as corporations. For accounting purposes, it is important to remember that all forms of business entities are considered separate from their owners. What that means is that if you are a sole proprietor or partner business entity, it is important to keep your business and personal finances separate. Though it will not eliminate your personal liability, it will demonstrate your intent of separateness and professionalism by handling all business records separate and apart from any personal records. The separation of business and personal finances is also an important aspect of good internal controls for a business to lessen the chances of theft or fraud. Internal controls are beyond the scope of this course, but it is important to understand that as a bookkeeper, you want to keep the handling of the monies and the recording of the transactions separate to keep the integrity in the business record keeping intact. And now we're going to get into a definition of what double entry bookkeeping actually is. It's important to remember that double entry bookkeeping is the foundation of a sound accounting system. If you think about your checkbook, when you subtract money out or add money to it, this is what we call a single entry bookkeeping system. In a double entry bookkeeping system, you're going to have two or more accounts affected for each and every transaction recorded. These entries need to remain in balance for the system to work properly. We set up accounts to record the transactions. In the exercises for those doing the entire course, we'll be having each transaction affecting two accounts. Those two accounts are opposite of each other. That's how the system remains in balance. When we get into the hands-on components, it will make sense. On our next slide, we talk about our chart of accounts, which we use to set up to record our transactions. As was mentioned in the previous slide, in a double entry bookkeeping system, accounts are set up to record the transactions. 5 basic categories of accounts exist, and on this slide, we talk about the first 3 account categories, which are known as the balance sheet accounts. The first of those are assets. These are things you own, such as cash, bank accounts, accounts receivable, which is monies owed to you for credit sales, equipment, land, raw materials, and supplies. The second category is liabilities. These are things you owe, such as accounts payable, which are monies owed by you for credit purchases, bank loans, notes payable, which are monies borrowed through a promissory note instrument. The final category is owner's equity. This is your ownership of a business expressed in dollars contributed. In a corporation, owner's equity shows up as shareholder equity, retained earnings, or common stock on financial statements. For sole proprietors, you will see their name with a dash and capital outside their name, and that will show that it is a sole proprietorship that you are working with. Our last two chart of accounts categories are known as income statement or profit and loss accounts. The first one is revenues. Revenues are monies earned through the sale of a product, service, or both. Sample accounts include retail sales, wholesale sales, service income, consulting, bookkeeping work. There are many other categories for revenues, but basically the important thing to remember is that revenues track monies earned through the sale of a product, service, or both. And our last category for our income statement or profit and loss accounts is expenses. These are monies spent in the course of generating sales of a product, service, or both. Sample accounts include rent, advertising, travel, utilities, and telephone. These are monies, again, spent in the course of generating sales of a product, service, or both. Here on the slide at right is a sample chart of account with notes, and there's also a copy of this in your handout as well. Please remember the first three categories of accounts are balance sheet accounts, and the last two categories are income statement accounts. For those of you doing the entire course, the distinction among these categories is important to understand when we start our hands-on components. I know your head is probably exploding right now, but hang in there with us. I promise you, you will get there. And now we can talk about the accounting equation. It's important to remember that the accounting equation is the foundation of a sound double-entry bookkeeping system. The accounting equation simply states that assets equal liabilities plus owner's equity, and we show that equation in your handout and on the slide here. With each transaction recorded into our bookkeeping records, everything must remain in balance in accordance with the accounting equation. For those of you taking the entire course, this will make sense as we do the hands-on components. And now we briefly overview financial statements. Financial statements are developed from our accounting records. These statements enable company leaders and outside parties to determine if a business is making or losing money, as well as determine how much debt or capital a business possesses in relation to the owner's stake in the company. The income statement, which is also known as the profit and loss statement, and balance sheet are the two financial statements we will work with in this course. We will now provide an overview of how both of those statements tie into the importance of sound bookkeeping principles that are grounded in the double-entry bookkeeping system. We will first discuss the income statement or profit and loss, as it's also otherwise known. This statement demonstrates your company's net income or net loss after expenses are subtracted from revenues in accordance with the following equation. Revenues minus expenses equal net income or net loss. Now, if revenues are greater than expenses, then the business shows a profit or net income. Conversely, if revenues are less than expenses, then the business shows a loss or net loss. And these come out of the company's owner's equity. Here in our slide, we show a sample income statement for KG's Consulting. For example, let's say that after expenses, KG's Consulting shows a net income of $20,000 at the end of the accounting cycle, which ends December 31st, 20XX. Here at right are how the numbers are shown on the income statement. As you can see, we had $23,500 in service income, which is our revenues, minus our expenses for various categories such as advertising, charity, dues, and subscriptions. You get the picture. We add up those total expenses, we subtract those out from our total revenues to arrive at our net income figure of $20,000. Now we talk about the balance sheet. The balance sheet, along with showing the relationship among assets, liabilities, and owner's equity, serves to prove the accounting equation remains in balance at the end of the accounting cycle. After adjusting for either a net income or net loss, which was computed from the income statement, the owner's equity section of the balance sheet will increase or decrease accordingly. The net income or net loss will be integrated into the owner's equity portion of the balance sheet to arrive at a new balance for the start of the next accounting cycle, which we will demonstrate on the next page and on the next slide. Here at right is how the net income of $20,000 from our income statement for KG's Consulting is treated on the balance sheet as of December 31st, 20XX. Before integrating the new net income figure in the updated balance sheet, we start with an owner's equity opening balance of $100,000 for the year ending December 31st, 20XX. In our example, our balance sheet will show the net income earned for December 31st, 20XX as a separate line item at the end of December 31st, 20XX. For a sole proprietor business, the net income figure will be integrated with the capital balance as of January 1st, 20X1. As you can see in our balance sheet example, the net income figure of $20,000 increases Kathy Grosskirth capital from $100,000 to $120,000, which is $100,000 starting owner's equity balance plus the $20,000 net income balance. If the $20,000 had been a net loss, then we would have decreased the amount to arrive at the new owner's equity balance. Please note that this example is only one way of handling the integration of the net income or net loss into our balance sheet. Another method is using a statement of owner's equity, which we will cover in our preparing financial statements exercises later in the course. And again, here at right and in your handout is how the balance sheet will appear at the end of December 31st, 20XX. Congratulations, you just completed the first module in our Bookkeeping Basics class.